In preparation for the discounted cash flow valuation of Red Bull, we need to calculate the cost of capital. And we're going to do that by looking at the comparable companies, because Red Bull is a private company, so we have to look at comparables to calculate the cost of capital. Now, although it's called the cost of capital, actually a better way of thinking about it is it's the expected return that investors require for investing in this asset. And you can see here we've got our comparable companies. We've got Coca-Cola, Coke, Dr. Pepper, Monster, PepsiCo, and Beverages. And we've got some key data for them: the market cap, the debt, a leverage multiple, a beta, credit rating, and a marginal tax rate. The first thing we're going to do is calculate the debt over capital. So I'm going to take the total debt divided by the total debt plus the market capitalization. And we get debt over capital, and I'll just copy that down. I could use a median calculation, but I'm going to use an average calculation here. And that's the average leverage in the sector. And now what we need to do is we need to convert the debt over capital ratio into a debt over equity ratio. And if debt is 14% of capital, it means that equity is 86% of capital. So I can calculate the debt over equity by taking the 14% divided by 1 minus the 14%, which is 86%. And that will give me the debt over equity ratio. And I need this because I need to deleverage my reported beta, the historical beta. So I'm going to use the historical beta, and then I'll divide that by 1 plus the debt over equity percentage. And what that does is, because 1 plus 16.3% is greater than 1, it will decrease the beta. But then there's a dampening effect because of the tax deductibility of interest. So I'll multiply that by 1 minus the marginal tax rate, and I'll copy that down. And always just check to see if the unlevered beta is lower than the levered beta, because it should be. And then finally, I can do a quick average calculation for these unlevered betas. So that would be kind of industry beta, or the asset beta, or the unlevered beta. They all mean the same thing. Then what I'm going to do is I'm going to come down and I'm going to calculate WACC. So the key benchmarks here, we've got the risk-free rate, which in most jurisdictions will use a 10-year government bond. Some firms use 20 years, but you should check. And this is the 10-year risk-free rate for the European market, or the Eurozone, because Red Bull is based in Austria. The risk premium is usually given to you by your firm. It's fairly controversial, but you should use what is the policy internally. Then we're going to pull in the industry average unlevered beta, which we calculated here. And I'm going to pull in the marginal tax rate for Red Bull from the model. And I'm going to come down here and I'm going to take the projected marginal tax rate, because that will reflect better the future, and we're valuing the firm in the future. Now we need to get the industry average implied debt as a percent of equity. It would be tempting to use the leverage ratios that we've got in the column, which is the industry debt over equity. We shouldn't do that. We need to make sure that our weightings are consistent. And we're going to be using the 11.2% in our WACC weightings. So therefore, I want to convert that into an average debt over equity ratio. So I'll take the 11.2%. So that is 11.2% of debt in the capital structure, which means that the equity percentage is 88.8%. I'll just take that and divide that by 1 minus the 11.2%. It's a similar conversion that I did before. So now I'm going to calculate the implied debt as a percent of equity. I can't use column L because I need to be completely consistent between what I'm applying to the beta as the weightings in the WACC calculation. So I'll take the 11.2 and I'll divide it by 1 minus 11.2 to convert it into a debt over equity ratio. I can re-lever the beta by taking the 0.72, but in this case times 1 minus the tax rate, the marginal tax rate. So that means my lever beta should be higher, and it is. It goes from 0.72 to 0.79. So the cost of equity, the three building blocks we've got, is the risk-free rate, the market risk premium, adjusted by the relevered beta. So I'll take the risk-free rate, I'll add the market risk premium, and I'm going to multiply by the levered beta, and I get 7% of my cost of equity. So I'm just going to take 1 minus the average debt in the capital structure, and I get 88.8%. And then for the cost of debt, that's more straightforward. because we've got a simple corporate spread. So corporations can't borrow at the same rate as governments. So we're going to add that spread to the risk-free rate, and that will give us our cost of debt. But of course, the firm has a tax deduction on interest expense. So we'll take the 3.7 times 1 minus the marginal tax rate, and I get 2.8%. And then debt as a percentage of capital is simply a reference to that 11.2%. And finally, we can calculate the WACC by taking the cost of equity multiplied by the equity weighting plus the cost of debt after tax multiplied by the debt weighting. We get an overall cost of capital of 6.5%. Once we've calculated the cost of capital for Red Bull, we can now actually take the cost of capital and apply it to discounting the free cash flows. First, we need to calculate the free cash flows, and most of the information is going to come from our three-statement model. You don't need to build a three-step model to do a DCF. You can just forecast the individual cash flow items, and that's a much faster process. But given we have a three-step model, it makes sense to actually reference the key line items on the model. I'm going to start with the key line items in the historical years, but for the cash flows, I'm only going to focus on the future years because you'd only get the cash flows in the future. The cash flows historically have already been captured in the cash balance. So the first thing I'm going to do is pull in the key numbers from the three-statement model. I'm going to go and get the EBITDA from the Red Bull model in the first historical year. Then I'll pull in the EBIT from the Red Bull model as well, again from the last historical year. And I'm going to pull in the long-term effective tax rate as well, because I'll need that, and that will be from the assumptions. And I'll pull in the effective tax rate there. And then the net operating profit after tax, I can calculate in the historical year. I'm not going to use it for the cash flows, but it's quite a useful benchmark because it means we can do our returns in the historical years too. And the net operating profit after tax is essentially EBIT times 1 minus the long-term effective tax rate. You may find that some bankers, when they calculate NOPAT, would prefer to use the marginal tax rate, but I think it's appropriate to use what we call a long-term effective tax rate. It's the average tax rate that the firm's going to face over time. Now, these are my key metrics. So I'm actually going to copy these across to the end of the forecast period. I wouldn't normally do this, but because I need them for the historical years, unlike the rest of the cash flows, I'm going to do that. So now I'm going to start in the projected year and pull in the key line items from the cash flow statement in the three-statement model. Free cash flows is primarily capturing the cash flow from operations and the cash flow from investing activities on the cash flow statement. The key difference is that the cash flow statement starts at net income, and net income is after the interest lines. But our free cash flows and our DCF must start with earnings before the interest lines, but after tax. And that's why we calculate this almost hypothetical number called net operating profit after tax. And that's the net income the firm would have if it had no interest income and no interest expense. So I can get most of these line items from the cash flow from operations and the cash flow from investing activities. So I'm going to go back to my three-step model, go down to the cash flow statement, and I'm going to pull in my depreciation line first. Then I'm going to get the increase/decrease in the operating working capital. Now here, there isn't a line in the three-step model for operating working capital. So what I'm going to do is I'm going to do a sum function, which will just add up all the sections in the cash flow from operations related to operating working capital, which is everything from accounts receivable down to accounts payable. And I'll put that in. And then I'm going to pull in capital expenditure as well. And you may be wondering why I'm not including financial assets. Well, I don't want to include financial assets in my free cash flows because I have not included interest income. So instead, my free cash flows will give me the value of the firm excluding cash and financial assets. So once I've got the enterprise value from the discounted free cash flows, then I can add on cash and financial assets to get my equity value, obviously deducting debt at the same time. So this means it's pretty straightforward in this model to calculate the free cash flows. And what I'm going to do here is I'm going to copy this across, primarily because I want to be able to articulate the development of the ratios below. So I'm going to copy this across to get our free cash flow forecast. Once we've done the free cash flow forecast, it's very important to look at the ratios to really establish whether you truly have reached a steady state by the end of the forecast period. And what does a steady state mean? Well, it means that our revenue growth has slowed down to a sustainable long-term level. So let's firstly calculate the revenue growth for Red Bull. I can either calculate it from the income statement, or I can take it from the total revenue growth, row 12. And then I'm also going to pull in my EBIT margin, which again is probably in the financial ratios. If I go down, yep, I've got an EBIT margin there, so I can pull that in. It's the wrong year though, so you just got to watch that. So I'm going to change that to a D, so this both should be in column D. And then I'm going to copy this across because I can't calculate the cash conversion ratio until I've got my free cash flows. The cash conversion ratio measures what percentage of NOPAT is converted into free cash flow. So I can take my unlevered free cash flow and divide it by the NOPAT. So in 2024, about 82% of NOPAT converts into free cash flow. Now, what we should see is that as the growth in the business starts to fall, and you can see that our growth goes down to 2.6%, which is just above inflation, we should start to see the cash conversion ratio increase. And the reason for that is that as your growth slows, you need to invest less in operating working capital and capital expenditure. And that's exactly what happens here. As the growth slows, the cash conversion ratio rises. Now, in an ideal world, we really should have the growth rates in the 2 final years pretty consistent. However, in this case, it's not going to make a material difference. But what we do need to understand and think about is that the last year's revenue growth should be similar to the long-term growth rate we're going to apply in our terminal value. And that 2.6%, the long-term inflation target for most countries, certainly in EMEA and the Americas, is around 2%. But you don't want to be right at the inflation level because it means you've got a static business. And if you have economic growth, you would normally expect the business to certainly start to have some growth if the economy grows. Not necessarily at the same rate as the economy, because it means the company will never be crowded out by new technology, and that does happen. But I think 2.6 is not an unreasonable long-term growth rate for the firm. Then what I'm going to do is I'm going to take a look at the returns. And we're going to first calculate invested capital. And there's 2 ways in which you can do this. You can either approach it from the perspective of investors giving capital to the business, the operational business, or you can look at what has been invested in the operational business, like net PP&E, operating working capital, etc. It's easier, generally, calculate it on the basis of your net debt plus shareholders' equity. So I'm going to go to the balance sheet of the Red Bull model and just always check we're in column E here. So I'm going to take the numbers from column E in the Red Bull model, and I'll go to the balance sheet and I want to calculate the net debt. So in column E, I'm going to take the revolver plus the long-term debt minus cash. That's my net debt. And the reason I want net debt is I only want what's been invested in the operational business, not in financial assets. And then I'm going to add to that the shareholders' equity in the same column here, and then I'll hit enter. And I get invested capital of 3,876. Once we've done the key performance ratios like revenue growth, EBIT margin, and cash conversion ratio, we now need to take a look at the invested capital. And the aim here is to understand that as a company starts a slow growth, that's usually caused by a lowering of the return on invested capital, and specifically not just the average invested capital, but the incremental return on the incremental investment. And we measure that by something called return on new capital invested. We'll start by just calculating the invested capital. And the easiest way of doing this is just looking at what investors have given the business. But this is using book values. So we'll take net debt plus shareholders' equity. And I'll go to the balance sheet in the 2023 year on the Red Bull model. So I'm going to take the revolver balance. I'm going to add the long-term debt balance. I'm going to subtract cash. I should also subtract any financial assets too. And I'll add the shareholders' equity. And that would be my invested capital balance. Then what I'm going to do is I'm going to just calculate how fast that is growing. So if I just copy this to the right, and then I can calculate the implied growth rate and copy that to the right. And we should start to see, as the overall revenue starts to slow in growth, the invested capital also starts to slow. And actually, really what's going on here is that the returns, as they fall, investors start to say this is less attractive as an industry and therefore will allocate less capital. So supply doesn't expand as fast, and that reduces the overall industry growth rate. And you can see by the end of the forecast period, our invested capital is only growing by 3%. So the return on invested capital, we take the NOPAT number, which is net operating profit after tax, divided by the average of last year and this year's invested capital. Now, the problem with a company like Red Bull is that because of the intangible assets in the brand of Red Bull and all the marketing spend that goes into the creation of those intangible assets, the return on invested capital is a crazily high number in comparison to the cost of capital, or our WACC calculation. And you often find that with companies with huge amounts of intangible assets that are not on the balance sheet. So what we're really doing is looking at the trend in this number, and we should normally expect it to decline as the growth slows, because the decline in the returns are causing that growth to slow. The next item is to do the return on new capital invested. And what we're looking at here is we're looking at the incremental growth in NOPAT versus the incremental investment in the business. So I'll start by taking the 2024 NOPAT number, and I'll subtract the 2023 NOPAT number. So you can see that there's been an increase in profits. What then we want to do is divide that by the increase in the invested capital. So we're trying to measure for that investment how much increase in the profitability did we get. And that will kind of give us a return on the investment. So you can see the incremental return in 2024 is 20%. And this is the key, because imagine you're McDonald's, you will keep opening branches until the incremental return of the next dollar invested is close to your cost of capital. Now, again, it's a bit messy for a company like this, because you can see that we have got a pretty high return on new capital invested, but it's the trend, and it's fallen in 26 from 88.8% down to 51.7%. So it's the trend that we're really interested in. You sometimes at the beginning get a little bumpiness as the asset efficiency ratios stabilize. So I'm going to ignore these couple of years. But that gives us a good overview of the returns, and the forecast does make sense because our returns are falling, our investments slowing, and our growth in revenues is slowing as well. So that makes a coherent story. Next, we want to calculate the terminal value of the firm. We've been given a long-term growth rate, and that long-term growth rate, which is hard numbered, should be consistent with the final growth rate in the forecast period of 2.6. Because what we're saying is that from that point onwards, our column O, or 2032, the company is going to grow to infinity and beyond at a constant growth rate. So we need to make sure our asset efficiency ratios reflect that. I'm going to pull in WACC from the WACC sheet in this model. And we calculated that at 6.5%. Then what I want to do is I want to calculate the terminal value using the Gordon growth model. And the way the Gordon growth model works is it takes the first free cash flow and it will discount that, and all future cash flows growing at a constant rate, it will discount those as well. Now, because it discounts the first cash flow that we give it, actually we don't want to use 2032 because it will give us the value actually in 2031. So what most analysts do, because they want to put the terminal value in the final year of the forecast, is that they actually grow the 2032 or the last year's cash flow out one more year. And that will give us the cash flow in 2033 in this case. And because I'm growing a cash flow, I need to use the long-term growth rate. And then I'll divide that by the cost of capital, which is 6.5, minus, again, the long-term growth rate of 2.6. So what that does, it gives me the value, in this case of Red Bull, beyond the 31st of December 2032. And because we're assuming the cash flows are in the middle of the year, and because we use the cash flow in the middle of 2033, because we grew the 2032 cash flow out one more year, that means that 101,825 number is in the middle of 2032. So we're valuing the firm at about 101.8 billion euros. Now, we've used a Gordon growth model, but it's useful to do a sanity check, and we can do that by calculating an implied terminal EBITDA multiple. And the multiple we are effectively implying is an LTM multiple. And this is because when we move multiples through time, it's always good to use a multiple that has a consistent relationship between the value date and the earnings period. We could use an NTM, or next 12 months multiple, but it's more common to use an LTM multiple. And what this means is that when I come to do the calculation, I need to make sure that if I use my EBITDA in 2032, that the value number is at the end of the period. And the problem we have is that the value number we have created or calculated of 101, that is a mid-year value number. So what we have to do first is we've got to move that to the end of 2032. And when we're moving value numbers, we use the WACC calculation. So I'll take that number times 1 plus the WACC, and I'm going to take it to the power of 0.5. And that will actually move it out 6 months forward to the end of 2031. Now, you can see it's slightly higher because that's the value that investors would buy the ongoing stream of cash flows at the end of 2032 compared to what they'd pay 101,825 in the middle of 2032. But because I wanted the implied multiple, I'm going to take that calculation and just divide it by the EBITDA in this 2032 year. And that gives me an implied terminal multiple of 16.8 times. And that is using a year-end value divided by the earnings 12 months prior to that, which is for the year 2032. Once you've done the terminal value, we can now move on to discounting. And in this model, and in most models you'll see, people like to see the breakdown of the discounting. And the reason for that is that you can see it on a paper printout or a PDF, and then you can try and reverse engineer the discounting to check it's correct without being able to see the underlying formulas. We're going to assume that the cash flows are gradually generated through the year. Every single day, Red Bull will generate some cash as it makes sales. So this means on average, the cash flows are received halfway through the year. So we're going to reflect that in the discounting. And we're going to start with 0.5 as our key metric. And then going forward, we'll take 0.5 and then just add 1 to it. And I'll copy that out. Then the discount factor, if we think about a discounting equation, if I just write this out, most people will think a present value is equal to a future value divided by 1 plus the discount rate to the power of the year number. However, that formula can be rewritten because the present value is also equal to the future value times 1 divided by 1 plus the discount rate to the power of the year number. And that last piece of this slightly rewritten formula that I'm going to put in square brackets here is known as the discount factor. And before computers, accountants would actually use discount factor tables to do present values. But in our situation, it's nice to actually see the discount factor because you could try and reverse engineer the discounting to check that the formulas were correct. So we're going to use this end bit of that second formula within square brackets to do our discount factor. So I'll do 1 divided by 1 plus the cost of capital and make sure you absolutely reference it. In this model, it's been given a range name. So that's automatically absolute referenced if it's a single cell to the power of the year. And it's a year, but it's really kind of half a year that we're discounting it by. And then I'll hit enter. And that essentially means that each dollar received, in this case on June 30th, 2024, is worth 96.9 cents at the beginning of 2024. So you will see that percentage decrease over the forecast period. And each dollar received on June 30 in 2032 is worth 58.6 cents in today's money. So this allows us then to calculate the present value of the free cash flows by taking our free cash flow at the top multiplied by the discount factor. And I can copy that right. So you can see that as the company grows, the free cash flows grow, but actually eventually they're not growing as fast as our WACC calculation. And that means that in present value terms, the cash flow declines over time. So it kind of rises because the company is growing fast. And then when the growth rate starts to go below the WACC, the present value of the cash flow decreases. So then we can sum up the whole forecast free cash flows and we get the value of Red Bull during the forecast period, which is about 19.3 billion. Then I'm also going to take my terminal value number. And because I used the Gordon growth model, which is a cash flow methodology, I can just take that and multiply it by the discount factor. And that will give me the present value of the terminal value. And usually that's at least 60 to 70% of the overall firm value. Obviously, the longer the forecast period, the smaller percentage the terminal value will be, and the shorter the forecast period, the higher the percentage of the overall value the terminal value will be. Added together, these two numbers give us our implied enterprise value. And then once we've got the implied enterprise value, we can then cross the bridge to the implied equity value. So I'm going to add cash and any other financial assets, and we've got some long-term financial assets. So I'm going to go to the balance sheet in the model, and I'll pull in the last historical cash balance, and I'll also pull in the financial assets number as well. So they will increase value because they're excluded from the enterprise value. And then I'm going to deduct the value of the debt and revolver because we're just looking at the equity value here. So I'm going to go back to the Red Bull forecast model, and on the balance sheet, I'll take the revolver number. And even though it's 0, it's good practice to take it. And I'll add in the long-term debt as well. And so my implied equity value is going to be the enterprise value plus any other financial assets minus any prior claims, which is debt and revolver. And that gives me an implied equity value of 80.2 billion euros. So it's quite good at this point just to do some checking ratios. So I'm going to compare that to the 2023 EBITDA multiple. EBITDA is before interest, so I must use the enterprise value. So I'll just divide that by the 2023 number, and I get about 25 times. And then I've got some forward multiples here. Again, the enterprise value divided by the EBITDA in 2024, and then the enterprise value divided by EBITDA in 2025. And you can see that the multiple is declining, which is what you'd expect. But the key thing to do now is compare that 2023 EBITDA multiple to the implied terminal value multiple. So the implied terminal value multiple is 16.8 times, significantly lower than the implied EBITDA multiple for the whole forecast period. And the reason for that is that as growth slows, you would see the multiple contracting. So this really makes sense as an overall concept in the model. Once we've done the discounted cash flow valuation, there are two numbers which we don't have a complete confidence in any single assumption. And that is the long-term growth rate and the cost of capital. So it seems reasonable to build some kind of sensitivity to these numbers, but be very careful. You want your sensitivity to be quite minor. You don't want to have big swings in the long-term growth rate or big swings in your cost of capital. Otherwise, you'll be able to drive a truck through the valuation ranges. So in the data table, we've got a range here of WACC, and we've got a range of our long-term growth rate. Okay. One thing you want to be careful about is that you don't want to connect these midpoints of the data table to your actual assumptions in the model. There is a workaround to that. For certainly people who are new to this, I would make sure that you hardwire this. Now, this is connected to a number here, and that's connected to the WACC calculation on the other sheet, but it's critically not connected to this WACC here. So you want to make sure that you don't connect those data tables. And you can see this number here for the long-term growth rate is just hardwired. So the first thing I'm going to do in the top left-hand corner is I'm going to pull in the implied enterprise value, because that's the title of this sensitivity. And that's the current enterprise value. And then I'm going to select the whole data table, including the variable ranges. And we're then going to tell Excel to build a sensitivity table, or what they used to be called a what-if table. So if I do Alt-DT, that's a little secret shortcut for data table, Excel knows we've selected the area, and it's expecting the answer to be in the top left of the selection. It's expecting the variable in a column to be in the left-hand column, and it's expecting the variable in the row to be along the top of the row. What it doesn't know is where the assumptions are in the model. So the row input cell is the long-term growth rate, because that's at the top. And then the column input cell is the WACC calculation. And you must use the WACC calculation in the model. You must use that because Excel is changing that number, and it wants to see what happens to the answer when the numbers change. Then I'll hit enter, and you should see the calculation. Now, in this case, it probably means that I have not got automatic turned on in my calculation. So if I do Alt-FT and I go down to formulas, can you see it says automatic except for data tables? And this is put on in a lot of models because data tables are really, they're like kind of Count Dracula when it comes to the CPU unit, central processing unit, because it's literally sucking the lifeblood out of Excel's process. And the reason for that is that every time you make a change, Excel has to recalculate the model 25 times. And if you have iterations, it will iterate 5 times for each calculation. So that's actually 125 times the model has to recalculate for every single change you make. So all you need to do is hit the F9 key to recalculate. I'll actually need to use my menus to do this, otherwise I'll turn off recording, and I'll just choose calculate now, and you can see the data table has populated. And we have a not unreasonable range of a low point of 72 million and a high point of 87 billion. I can then do the implied multiple, the 2023 multiple, and this is going to be much quicker. So I'll go and get the current answer for the 23 multiple. Then I'll select the data table Alt-DT, The row input cell is my long-term growth rate. The column input cell is my WACC calculation. And I'll hit enter. And then I've got to just recalculate the model. And then the implied terminal value multiple, I'm going to go and pick up on the calculation here, the 16.8. And then I'm going to select it, Alt-DT. The row input cell is the long-term growth rate. And then the column input cell is the WACC. So once you get used to this, you can do it pretty quickly. And again, I'll need to recalculate the model. And there we go. We've built 3 sensitivity tables for this valuation.